We're once again hearing about dangers to our economy, dangers to the market. As a matter of fact, as I think about this over the last 6 years, it seems almost every day we've had some danger that we needed to take action against. I jotted down a couple of them. We've had resetting of the ARMs, those adjustable rate mortgages. The rates were going to go up. That was going to be a problem. We've had Cyprus in the news somehow default when Cyprus debt was going to cause the markets to crash or the economy to go bad. The dollar's reserve currency status was changed or challenged at one point. Unsold homes inventories, Greece, they've all recently been in the news. As a matter of fact, Greece may in fact default on its debt to the European Union. But the one that we're hearing today is there's been some slowness, some weakness in the earnings of S&P 500 firms, and that coupled with the imminent rise in interest rates represents a danger that we need to take action against. Now, of all the things that we've heard of, all the dangers we've encountered over the last 6 years, the one that we actually take a bit seriously is earnings and interest rates. After all, they're two of the key factors in our pricing model, our model of what tells us whether the market is overvalued or undervalued. So when we hear analysts whom we respect saying that there's been weakness in the overall S&P 500 earnings, we take that seriously. We're not demeaning the statistic, we're not saying it's wrong, but acknowledging the statistic is there is different than saying that the components of that statistic, which have caused the decrease, leads us to different conclusions. We want to look at the components. And what we find is that energy prices are the ones that have been going down, and so energy stocks have been going down. This is driving that down. That's not necessarily the same thing as that there's going to be a problem for the economy. In fact, as we look at it, we want to reaffirm our valuation for the market right now as being fair. So what I'd like to do is cover a little bit where we've been, where we are, and where we're going to go. The first little bit of history, I think, and this gets a little wonky, a little technical, so please bear with me, is energy stocks, energy pricing represented about 10.9, make it 11% of the S&P 500 historically. So it's only natural that any change in this sector, in its profitability, what's happening there is going to impact the index. Oil and gas natural prices, as we all know, they've come down dramatically in the last several years. And in fact, since 2014, they've down 40%. That's a sizable drop in the price of anything. So the index is down. We know that. But we have to stand back and ask ourselves a couple of questions. First of all, is the energy sector as important to the overall economy as it is to the S&P 500? Secondly, we need to ask ourselves, well, what's happening with the overall economy? And then thirdly, we might ask ourselves, what's the long-term effect of energy prices, natural gas prices, going down? Is it positive, negative, or neutral? So let's take those all one at a time. First of all, the importance of energy. As I mentioned, we want to look at the whole economy. We look at all corporate profits. It's very easy to talk about the S&P 500, the Dow Jones Industrial Average, because they're easy indexes, they're top of mind, they're quoted in the popular press. But the Dow is 30 companies, the S&P 500 is 500. We're looking at total corporate profits. The energy sector represents 3% of total corporate profits, so clearly the energy sector is not as significant or important to the overall economy as it is to the S&P 500. But what about the overall economy is doing fine. Even if we look at the slowness that's been reported in some of the first quarter GDP, which, by the way, includes, we had a port strike, an unusually harsh winter, and we've had those falling energy prices. But even including that, we see a 2% growth in GDP. Now, we've referred to that in the past as the plow horse economy, and we still will. But just because we've got a growth rate that's slower than we want is not the same thing as saying that we are actually going to have a contraction. There's nothing that tells us we're going to have a contraction. And in fact, corporate profits overall are up about 4.5% to 5% from where they were a year ago. We're doing fine. The third question that I suggested that we ask, what's the effect of decreased energy prices? Well, let's consider any manufacturer of any good. A company that buys something, turns around and uses that to produce a product. They naturally want to see the cost of what they're buying, their raw materials go down, the cost of what or the price of what they can sell to go up. This is just natural, it's human nature, it's what increases profits. Clearly, the energy companies themselves are going to see in the short term their profits squeezed. Their costs right now are a bit set. The prices of what they can sell energy for is coming down. Their margins are getting squeezed. Over the long term, they will readjust their cost structure. Their profits will come back. But for the overall economy, we have lots of manufacturers of products that use energy in their manufacturing. We have lots of distribution transportation companies that are shipping those products across the country using trucks, trains, boats, planes that use energy. They're seeing their costs come down. That means the prices of those products that are manufactured, that we consume, the prices of those products that are shipped, that we consume, are coming down. The effect of falling energy prices is a good thing for the economy. There are more companies and people that benefit from the decrease in this sector's prices than are harmed by it. In a sense, our standard of living is going up. We're creating more wealth by virtue of energy prices decreasing. So there's nothing to worry about in terms of the economy. There's nothing to worry about in terms of the effect of decreasing energy prices. In fact, it's a good thing. But the last component of this is, what about stock prices? Where are they? What's going to happen to them when interest rates rise? I said it's imminent. Whether it's July, the fall, the winter, they're going to go up. We look at, mentioned before, interest rates and profits as we do that calculation. In fact, it's almost a little simple division. We take the corporate profits of all the companies after taxes and we're dividing it by some factor that represents interest rates. We use the 10-year Treasury note. It's about 2.35%. today. If we take all those corporate profits, again, I know I'm getting a little wonky, but it's important that you understand. You take all those corporate profits, you divide it by that current interest rates, we would say that the S&P 500 ought to be about 4,335. A very exact number, which doesn't mean a lot, it's more the range. So the $4,300 range rather, we're at 2,100 right now in the S&P 500. Hugely undervalued. Now we realize that interest rates are artificially low. They're going to go up. If we take a more historically normative 4% 10-year Treasury note and go back to our model and use that again to do that math, we still come up with an S&P 500 of about 2,500. We're at 21. We ought to be at about 2,500. This means we're undervalued by 15 to 17%. What would have to happen for us to say we're at a full value and anything above that represents a problem? Well, two things together. First, those interest rates would have to go up to about 4.8%. That would be a huge increase on the part of the Fed. That's not going to happen. But if that happened, and if corporate profits stayed frozen, only those two things together would lend us to the conclusion we're at a full value and anything above that is worrisome or problematic. So, concluding thoughts, one, don't be worried. The dangers that we hear about, they make for good press copy, good headlines, but they don't represent anything we need to worry about. Two, is there going to be volatility? Yeah, there's going to be volatility. It's part of the short-term price that we pay for the long-term growth that we get out of diversified stocks. There's still going to be irrational exuberance and irrational fear that grips the market from time to time. Can we see a correction? Not going to predict it one way or the other, but even if it is, off 10% tomorrow, this is not representative of overall profitability, not representative of overall economic growth. We are doing fine. Stocks are still somewhat undervalued. There's no reason to be worried. Hope that helps. Sometimes these things will prompt more questions than they answer, so if you feel you want to run something by us, we'd love to hear from you. Email, Facebook, give us a phone call. We'd love to talk in greater detail. Thanks again for listening.